Let's take a look at the basic idea behind the Black-Scholes option pricing model. Maybe it's not your first thought, but we can compare the movement of a rocket to those of option prices. So, how does this work? First, we introduce you to the development of option pricing model. Before the 60s, traders and investment bankers believed that they can predict price movement based on their knowledge and past experience. Academics tried to build models including variables such as investors' expectation, aggressiveness, or attitude towards risk, but they failed because they were too complicated and they have variables were too hard to measure. In 60s, the common belief was that price movements shows a pattern of randomness that was then called Brown motions. In 1973, the Black-Scholes model was published, which changed the world of financial derivatives. So how can we link all this to rocket science? Both rocket science and the Black-Scholes option pricing model use very small time frame to predict the risk. So who are the brilliant men behind this scene? Fisher Black was a Harvard graduate. Scholes became interested in economics in his early age, and his parents helped him to open an account for investing in stock market while he was still in high school. Robert C. Martin is still a professor at MIT, Sloan School of Management. In 1997, the Nobel Prize was given to Martin and Scholes. Unfortunately, Black died in 1995. The formula gained popularity and was used in Scholes Investment Fund, a long-term capital in management. They collected trillions of dollars from investors from all over the world. Initially successful with annualized return over 40%, LTCM was able to outperform the market in its first year. In 1998, it lost $4.6 billion in less than 4 months. The fund closed in early 2000. Judging by its crash in early 2000, we can definitely say the model had some limitations. So before we explain the model's limitations, let's take a look at the formula and its assumption. The assumptions we use to derive the Black-Scholes differential equation are as follows. First, no riskless arbitrage. Second, no tax or transaction cost. Third, risk-free rate is constant and same for all maturities. Fourth, no dividends. 5. Mu and theta are constant. 6. Short selling is permitted. 7. Securities trading is continuous. Now let's look at the different variables. SO is the current price of the stock underlying the option. K is the strike price of the option, that is the price at which the holder of the option has the right to buy the stock. RF, this is the risk-free interest rate at which the payoff of the option is discounted. Since the model assumes risk-neutral investors, we can use this risk-free rate. T is the time remaining until the expiration date of the option, the date on which the option is valid. Sigma is the volatility of underlying stocks, the standard deviation of the stock price 1 year from now. So let's look how the different variables affect the price of a call option. If the current stock price increases, so does the expected future stock price and consequently also the value of the call option. If the volatility increases, the expected payoff of the option increases because the payoff is asymptotically dependent on the future movement of the stock price. That is, it has no downside risk. If the strike price increases, the payoff from the call option is lower at any given future stock price, meaning that the value of the option decreases. If the risk-free interest rate increases, we have to discount the payoff of the option by a higher rate, which means that the value will be lower. If the time to expiration increases, the effect on which the value of the option is ambiguous. On the other hand, a longer time means a higher volatility of the stock price, pointing towards a higher value. On the other hand, it also means that we have to discount the payoff from the option a longer time, pointing towards a lower value. Thus, the impact of the time expiration on the value of the option depends on the relative level of the volatility and the risk-free rate. The first three variables are straightforward and easy to find. You can find the stock price and decide among a number of different strike price and times to expiration. For the risk-free rate, we can use the LIBOR, London Interbank Offer Rate, as an approximation, just to make sure to choose the LIBOR rate that corresponds to the time frame of the option. Finding sigma is a lot more problematic, since we cannot really know for sure how much the stock price can be expected to vary in future. One method could be to use the data of historical volatility of the stock to estimate the future volatility. But since both companies and circumstances change over time, we do not know whether this is a good estimate or not. A better way of finding the future volatility might be to try and derive it from the prices of option on the stocks that are traded in market using the Black-Scholes formula in reverse. If we know the option price and all other variables expect the volatility, we can easily find the volatility that is implied by the market price. Now we will show you how to actually do all this in order to find a reasonable price for an option. As an example, we use call option on stocks of Google Inc., which is a good choice since the model assumes that no dividend will be paid and since we can reasonably expect Google. However, if you want to extend the model to hold for dividend paying stocks, we would have to subtract the present value of all dividend payments due before the expiration of the options from the option price calculated with formula. First, we look at the current stock price, which on December 2nd, 2011 is $620.36. Second, we choose a strike price. Google options are traded with strike options in $5 increments. So let's pick. For the time, there are expiration dates every month. Let's pick an option which is expiring in March 12, 2012, meaning that we'll have a time of 101 days. And to express this in year, we divide it by 365. For the risk-free rate, we use 3-month LIBOR rate, which is currently 0.58% per annum. In order to calculate the implied volatility, we choose an option with a different strike price, say $620, and look up the market price for that option. Then we plug this into a formula and receive an implied volatility of 0.3019. In the real world, you'd probably do this for a number of different strike prices and expiration dates, but for simplicity, we settle for one iteration. Now we'll derive the Black-Scholes formula for Google Inc. and show you the exact calculation in real time. So we end up with an option price of approximately $42.83. We can now compare this to the actual market price of our option, which is $43.30. So it seems that Black-Scholes formula does a quite good job at predicting the market price, which might be either because it accurately predicts the true value of the option or because the formula is so widely used among traders that is it reflects in the market price. Now let's look at the limitation of Black-Scholes model. This is a normal distribution of the stock price movement. But as we have seen in 1997 in Southeast Asia, in 1998 in Russia, 1999 in Argentina, 2001 the dot-com bubble. So it is definitely can be said that the model cannot be applied for the period of extreme movement. Also, the model assumes that the risk-free rate and the volatility is constant, but in real life, it observed that they fluctuate a lot.